What a first quarter it has been. The worst for global markets in recent memory. Gold prices, spot prices on track for a monthly decline of 14.6%, marking the metal's biggest monthly drop in 17 years. The US and Israel attack on Iran has jolted 2026 macroeconomic outlook, and it's still too early to rule out yet another black swan event. All wars are deemed justified, with each side citing preferred historical narratives. The supposed unfair treatment of Germany after World War One at the 1919 Versailles Treaty has been used to justify World War Two. Some will say stopping Hitler before he became a more imminent threat would have saved millions. The mainstream narrative is that Trump rather foolishly elected to go to war, while he argues it was a preemptive move against a nuclear threat. But to what is clearer, the final session of a dismal 3 month stretch for the Wall Street indexes is on track to be the worst quarter since 2022. The quarter ends on a somewhat pessimistic note that even if we do get a quick peace, a messy aftermath could follow as we look at new high impact developments for 2026. First, inflation is back. The euro area saw its steepest jump in inflation since 2022 as the Iran war pushed energy costs sharply higher, reinforcing expectations that the European Central Bank will have to raise interest rates. An increase in energy costs elevated the Eurozone's annual inflation rate to 2.5% in March compared to 1.9% in February, exceeding the ECB target of 2%, also the most significant monthly rise since the 2022 energy surge. The European Central Bank Governing Council member Madis Miller said yesterday that there could be an interest rate hike by the central bank at the April meeting. With high inflation rate, we also could get a slowdown in global growth. A small bright spot, inflation rather than resolved in a permanent scarring, can be yet another transitional bump as supply chain adjustments settle. Second is a strained US NATO relationship. Will US NATO relations ever recover in the medium term, as Trump warns the UK and France that the USA won't be there to help them anymore, venting frustration over close allies' refusal to join military action against Iran? Trump told aides he would be willing to end the war even if the Strait of Hormuz remains mostly closed, urging oil buyers to buy from other markets, adding the US has plenty. Meanwhile, in the final days of Q1, an Iranian drone struck a giant Kuwaiti oil tanker off Dubai, briefly pushing up the price of Brent crude even higher. All this as Ukraine closely collaborates with Saudi Arabia and Gulf countries to strengthen drone defense systems. A significantly more fragmented trade environment will lead to increased trade costs. To give a flavor of where the direction is going, Jameson Greer, America's trade envoy, has said that the World Trade Organization would, going forward, play a limited role in determining global policy after talks aimed at reforming the body collapsed over the weekend. A small bright spot, King Charles and Queen Camilla visits the US in late April. We'll see what that yields. Thirdly, it may be time to actively diversify from fossil fuels as an energy source. The wisdom in diversifying energy sources and accelerating adoption of resource stroke energy efficient business models has never been more compelling. France, that has moved far more aggressively in adopting nuclear energy sources, is at an advantage over, say, a United Kingdom. Cleaner non-fossil fuels like biofuels, solar could see an investment boost, same as electrification of mobility, as volatility in cost of fuels pose fresh concerns. The bright spot is that there was already strong momentum in terms of safety of nuclear plants and lowering battery costs and costs of alternatives to fossil fuels. Fourthly, it could be time to buy cheap, compelling technology stock. That's the winners. Somehow, technology always seems to win in every scenario because the value proposition for the new artificial intelligence advancements are ultimately to make the world deliver more, far more efficiently, and with less resources and at lower cost. Though we do see that tech stocks have fallen, adoption of artificial intelligence, especially where the business case is more easily evident, is not just reversible, but much more likely to intensify. The challenge of energy costs for data centers is no doubt an issue as nuclear energy source alternatives are increasingly adopted. The time to buy perhaps is now, as the more compelling tech stocks have never been this cheap relative to the broader US stock market in 8 years. The Nasdaq 100 index, now 12% below its October peak, trades at just under 21 times forward earnings, only 1.7 points above the S&P 500. Historically, such a narrow premium has signaled outperformance for the tech benchmark. The Nasdaq also is fast tracking the process for newly listed large cap companies entering its main index. The so-called seasoning period will be slashed from over 3 months to 15 trading days, bringing forward major stock purchases by passive funds. The carrot comes as SpaceX plans the largest IPO in history. The London Stock Exchange Group is also set to be targeting 5 trading days for entry to its Russell indices. Finally, there are winners we did not foresee. At least 3 come to mind. Global defense and arms manufacturers, as escalation drives rapid consumption of missiles, air defense interceptors, drones, and aircraft, followed by large government orders to replenish stockpiles, boosting revenues and share prices. Although stock performance can lag initially due to production bottlenecks, the increase in tensions means far more will be invested in defense. Oil and gas producers located outside the Gulf region are also winners, positioned to benefit from potential disruptions or risks associated with the Strait of Hormuz, which may lead to increased oil prices. Energy exporters not reliant on Gulf shipping routes, including those in North America, South Sea producers in the UK and Norway, Canadian oil and gas firms, Russian exporters, particularly those redirecting oil to Asia and African basins such as Nigeria, are also likely to experience enhanced fiscal revenues. Additionally, the valuations of energy companies, which generally rise alongside crude oil prices, have shown notable increases, especially across Europe and North America. Volatility within oil and gas markets presents considerable opportunities for traders, refiners, and financial entities adept at leveraging shortages or price fluctuations. It is incumbent upon governments to remain vigilant in addressing potential profiteering, particularly as citizens face increased energy costs. Additionally, periods marked by extensive sanctions and geopolitical conflict often facilitate the growth of illicit trading networks encompassing shadow shipping, smuggling, and informal financial channels. Hello, this is Global Business Insight, where we look at the world from a business perspective and bring news, views, and analysis that helps to get up to date on the context. The dollar is headed for its biggest monthly gain since July and stands out as the strongest so-called safe asset as war in the Middle East set oil prices surging and nearly everything else sinking. raising risk of a global recession. McKinsey has highlighted in a report on Monday the African banking sector's growing economic importance as revenues topped $100 billion for the first time, with profitability well above the global average. Concentration has been, however, in a handful of markets. Banking revenues across the continent reached about $99 billion in 2024 and are estimated to have increased to $107 billion in 2025. Kenya's inflation rose slightly to 4.4% year-on-year in March from 4.3% a month earlier. On a month-on-month basis, inflation was 0.5% compared with 0.2% in February. The government targets year-on-year inflation of between 2.5% and 7.5% over the medium term. In Nigeria, a Palm Sunday attack in the city of Jos with at least 12 dead is an ugly reminder of the daunting security challenges facing the country. Also impacting Nigeria, Beijing will end value-added tax rebates on solar panel exports from April 1st, 2026 and gradually phase out incentives for battery manufacturing, a move that analysts say will lift costs across many African countries where most equipment is imported. For years, developers and households across Africa's most populous country benefited from a flood of low-cost Chinese solar modules, which underpinned everything from rooftop installations in Lagos to mini-grid projects in the country's underserved north. South Africa announced it will cut the general fuel levy by 3 rand, that's $0.1749 per litre for 1 month, to ease domestic fuel prices affected by the Iran war. The government said the short-term relief will remain fiscally neutral with lost tax revenue recovered through other means.
In KwaZulu-Natal, Toyota will be investing 10.4 billion as we had in preparing for energy transition in the automotive sector. Now, Toyota is one of those companies that has made South Africa its home. It operates well, even in times of challenges, like when we had the floods some few years ago in KZN, and it wiped out quite a lot of their fixed infrastructure. They remained committed. And I know they held a meeting in Japan and said, much of our company's infrastructure has been damaged, we will repair and we will continue being in South Africa. That is commitment, and we are grateful to Toyota.
Despite a challenging year, watch out for still rising Africa. South Africa is staying focused on its investment drive as it ends the quarter on a high note. At the 6th South Africa Investment Conference in Sandton, Johannesburg, President Cyril Ramaphosa announced investment commitments totaling nearly 900 billion rand, that's over $50 billion. These pledged investments are anticipated to generate approximately 222,000 permanent jobs. The plan is to attract about $116 billion in new investments over the next 5 years, offering a significant boost to economic growth and employment. There is hope that the next quarter will be better as European markets and US stock markets ended the last day of the first quarter in positive territory, also as traders bought into dips amid some optimism growing for an end to the war. The new trading month also seeing a strong rebound this morning in European and Asian markets. Asian stocks traded higher, while futures data pointed to a higher open on Wall Street. Well, that's all we can take on this special edition of Global Business Insights. This is Bodio Shosami. Do not forget to subscribe and hit the notification button. Do enjoy the Easter break. See you next week. Bye-bye.